My next guest says that an unfolding crisis in sovereign debt markets could become a major source of financial instability around the world. We're joined by a familiar face to this program, Martin Pelletier, Senior Portfolio Manager at Trivest Wealth at Wellington-Altus Private Counsel. Martin, thanks a lot for joining us. You've got a piece, I understand, in the Financial Post in which you say many investors remain unaware of the scale of what you refer to as an unfolding bond crisis. And the bonds you're talking about are some of the most highly regarded sovereign bonds in the world, including Japan and the U.S.
Yeah, absolutely. So as you had just showed prior for me coming on here, the TSX hitting new highs, the S&P market rallying back on tariff risk. Bond markets are pushing back, and bond markets are saying, look, your deficit spending hasn't been pared back a lot since COVID. And at the same time, we're having some risks like tariffs that are going to impact global economic growth. And so as a result, you're seeing government bond yields rise sharply. Japan, the 30-year bond yield just hit a record 3.14%, and the 40 years at 3.6%. In the U.S., you've got 20, 30 years that are over 5%. And so bond markets are saying, wait a minute here, we're not liking what we're seeing, and we're pushing back against this deficit spending.
Do you see anything in the legislation making its way through the U.S. Congress now that would satisfy bond markets or soothe bond markets somewhat? That's the so-called big, beautiful bill that's working its way through Congress?
Not yet. I mean, the price of credit default swaps and U.S. government debts recently has just rose to its highest level since 2023. And one of its highest levels since 2008. So bond markets aren't seeing it. I'm not seeing it. There just isn't a lot of faith. When you hear Besson come out and say, we're going to deal with this debt problem by growing our economy a faster pace than their level of debt, and yet its deficit is 6.5% of GDP, Doge cuts and other things really haven't made a dent there. And it's not just the U.S., it's Europe as well. France is running a 6% deficit, UK 5% deficit, Japan 2.2%, and Canada 2%. So, we're not seeing that getting pared back. And I'm not alone. I mean, it's not just bond markets. Jimmy Dimon came out and said that credit today is a bad risk. And others are shying away from that. And you look at demand for U.S. Treasuries, the $16 billion auction last week was at very weak, very, very weak demand. And so there's not a lot of demand for this long-term debt despite yields going to high levels. And that means that to go higher still. And unless we start to see some fiscal responsibility.
In your piece, you talk about what this means to ordinary investors. Ordinary investors, for instance, who may have a 60-40 portfolio, 60% equities and 40% fixed income.
Yeah, and so fortunately, the 60% of the portfolio has been quite erratic, and it's been quite the roller coaster ride this year. But that's what's keeping those portfolios alive, because the bond component has been a real drag. Interestingly, bonds may not be that saving grace. So if we continue to see that volatility in stocks correct, and there still is an extraordinary amount of complacency out there in equity markets, but if we do see a pullback in equities again with what we're seeing out of tariffs or whatever the risk du jour is, then bonds won't be there to save you. And so you'll see that 60-40 move up and down together. Now, that may cause investors to move out of bonds into stocks and add an extraordinary amount of risk as well, too, into the portfolios. And so you have to look at things beyond the 60-40 and maybe real assets, dividends, structured notes, and diversify out of that 40, because bond markets have a looming risk, in my opinion, and more so than what many 60-40 investors are expecting.
So as a portfolio manager, how are you navigating this looming risk in terms of choices for your clients' portfolios?
Okay, so on the 60%, maybe we're on a 60-40, maybe we're 50% long. We have options on that 50% long, so we try and mitigate the downside through put protection and other option strategies. And there are some ETFs that can help you do that, or you can do it yourself. The other 50% where we look at real assets. For example, we've been buying gold on the dip, on each of the dip. Gold producers are looking actually interesting because they haven't participated to the same extent as gold prices themselves. Infrastructure, like Brookfield Infrastructure, we like infrastructure as a inflation hedge. Toll roads, pipelines, companies are going to be able to benefit from that government spending that isn't getting pared back. And then structured notes have been a really good component for us. We can replicate a fixed income component or an equity component through a structured note. Some actually we just did one with a look back, so it's guaranteed to buy the markets at the lowest point over the next 6 months. So this is where a portfolio manager is really going to add some value for you as an investor beyond just the passive 60-40.
At what point does a looming crisis in the fixed income market, as you describe it, translate into weakened or damaged stock market prices, equity prices?
I think when we see it in earnings and the economy itself, and so we've hit the first wave here, and it's been all over the map. Big threats, and then coming back down again at 10%, and China. I think we're going to see a lot of that volatility over the next year and a half until the U.S. midterms, and maybe that's the stabilizing point. And so I think there's going to be a lot of volatility over the next year and a half here until we get to that midterm level, because a lot of this catalysts that are causing this volatility is coming out of the U.S. and trade wars. And I just don't see how slapping on 10, 15% tariffs is going to be beneficial to the global economy. Even the U.S. economy, you're looking at Apple and the cost of new iPhones and other factors. These are just not positive things that are happening in the economy. Now, economies and stocks do different things, and that's important to recognize. Having said that, the buck stops with earnings, and earnings have been okay, but we'll have to see. I think in Q2, Q3 will be the deciding factor as to the impact of what we're seeing.
Martin Pelletier, thank you, as always, for an interesting conversation. Martin Pelletier, Senior Portfolio Manager at Trivest Wealth at Wellington-Altus Private Counsel.